Good evening, good evening, good evening, good evening, everyone. Good evening. I am coming in here rolling today because uh, it has been a glorious day, but I have been busy, busy, busy. Um, so I'm rolling in here right at 7 o'clock, but we're here. We are here. So you guys come on in and join us. Come on in and join us. Hello, Mr. Booth. How are you doing tonight?
Doing good. How you doing?
I'm doing fine. I'm doing fine. First of all, I need to tell you, offer my condolences about your grandmother, Miss Pete. That
I appreciate
that's
that.
my buddy. That's
Oh,
my buddy. She's always called me her big baby. And Barbara said, "That ain't no baby, that's an old rusty woman." And she said, "But that's my big baby." Oh, so that was my
and truly
girl,
be
Miss
missed.
Pete. Yes.
Yeah, truly be missed. Thank you. Thank you very
hmm
much.
Yeah, yeah, yeah. But anyway, I'm sorry I was a little late. We had a no ordinary
Yeah,
worship at church today. So we had a big
that's great.
thing with the young
That's great.
adults. And then
Yeah.
most of them came here for dinner after we left church, and they are just leaving.
Yeah.
We have had such a good time
That's
fellowshipping, so they are
great.
just
That's
getting out of the
wonderful.
house. So my
Yeah.
kitchen look crazy, so I hope y'all don't see it because I got to clean up. Uh, but I had a fabulous time
Oh,
praising the Lord. And then
absolutely.
spending time with the young people. You have to spend time with the young adults because
You definitely
um,
have to do.
they keep
Yeah.
you they
All right.
keep you knowledgeable. They keep you young. They keep your
Absolutely.
mind fresh. So.
Absolutely.
mhm. So
We
welcome
all.
everybody. I see Duchess and Oscar Penn. Hey Oscar, how are you doing? Miss Darlene Todd, Miss Tiffany Williams. How's everybody? Welcome in, Miss Ann Davis. Thank you guys for joining. If y'all would please go ahead and like and share this video, invite a friend, and tell them Mr. Troy Booth is on with us again tonight, and he's given us some more great financial advice, something that all of us need to help us build generational wealth and to help us deal with our finances if we're trying to buy a home, if we're just trying to build our wealth, if we're trying to build our portfolios, whatever it is that we're trying to do. He's given us advice and we're trying to budget our funds, whatever it is. He is the financial expert, and he has really been giving us so much information the past 2 weeks. So we are excited about doing that. You all know that I am Juju. Uh, I am the host, and we're here in my living room. And so, anyway, we're going to go ahead and we're going to let Mr. Booth get started. He'll probably recap for us and then go on with what he has for us tonight. You can go ahead, Mr. Booth,
Absolutely.
and you guys feel
Okay.
free to ask questions, comment. Mr. Jackson said he may not be able to join us tonight, so I'll try to work the phones, but I'll do the best I can. Go ahead, Mr. Booth.
Absolutely. Absolutely. Tonight, before I actually do the recap, we're going to actually discuss how to manage debt and improve the credit. It is vital, and we continue to repeat these things because it's so important that we encourage and inspire everyone to change their mindset. So we will start off with the recap. And the first thing we're going to talk about is the 50-30-20 rule. The 50-20-30 rule serves as a simple yet powerful financial framework to guide individuals towards responsible money management, reducing financial stress while steadily growing wealth over time. And we talked about those essential items versus the non essential items and also the savings and retirement. So keep in mind that we want to be able to understand those numbers, that 50% for the essential, the 30% for the non-essential items, and the 20% for saving and retirement. The goal is to take more of the non-essential items and apply that to savings and retirement, therefore decreasing debt and having good debt in the 50% realm. So that it's one thing we definitely want to keep in mind. The next thing we want to discuss for us to recap is what is debt to income ratios. Your debt to income ratio, or DTI, is the percentage of your monthly gross income that goes towards paying off debts such as credit cards, car loans, and student loans. When you're applying for a home loan, lenders will also include your future mortgage monthly payment. Now, we talked about the front end ratios, and we talked about the back end ratio, which we refer to as the top and the bottom. And the percentages that we used last week was 28% for the front, and that would give you your total mortgage payment. And we also talked about the back end ratio, which is the bottom, which was 43%, which includes your additional expenses, those credit cards, student loans, and including the principal, interest, taxes, and insurance from the mortgage. Now, we also got into the different types of programs. We talked about conventional loans, we talked about FHA, we talked about USDA, we talked about VA, non QM, and the DSCR. Why is it so important to understand the programs? Well, for first time home buyers, you may have some challenges for its credit. We have been dealing with budget and we've been dealing with credit. So it's very important that you all understand the different programs that are available to you and the resources that are there to help you elevate yourself so that you will qualify for those loans. Remember, with the FHA, which requires 3.5% down, this is an insured loan. This is a government loan. You can get a grant, or the lender may offer a second mortgage, which is silent against that first mortgage. So the first mortgage would be 96.5%, and the second 3.5, which gives you a total of 100%. USDA is for rural properties, but it is 100%. VA is 100% for those veterans. And keep in mind, if you are a disabled veteran, you will not have to pay the funding fee. What is the funding fee? The funding fee is the fees that veterans pay into the pot. So when the other veterans default on the loan, that money is used to pay those mortgages off. One of the programs that I want you all to really concentrate on is the DSCR. And the DSCR stands for Debt Service Coverage Ratio. This particular program does not require the credit worthiness of the individual, but the credit worthiness based on the income that's coming in for the property. So as an investor, that first time home buyer can buy a 4 unit property, right? Okay, you're going to stay in one of those units and you're going to rent out the other three. You're going to be able to get into this property without the credit, but the quality and the rental amounts from that investment property to qualify for this loan. And we'll be talking about that a little bit more, because we have people that have credit challenges, and they're trying to figure out, okay, well, I understand that I need to own the asset. How do I get around the credit issue? This is one of those items. Also, piggyback riding on the FHA. FHA is for those individuals that have had credit challenges, but you have to understand your budgeting. You have to understand what DTI means, and you have to understand the guidelines. So that is the recap for last week. Any questions? We can get into that. If not, we're going to go ahead and go into this week's lesson, which is how to manage debt and improve your credit score. Again, it is layers on top of layers on top of layers. It is the mindset that we are actually trying to change. Once everyone starts to digest this information, you would be able to regurgitate it and use it every single day and pass it on to your family. That is the key, is that you're going to learn this information, you're going to use this information, and you're going to pass it down the line. So let's get into that. Buying your first home is an exciting milestone, but it also comes with financial responsibilities. Managing debt effectively and maintaining a strong credit score can help you secure better mortgage rates and ensure financial stability. Here's a guide to help first-time homebuyers navigate debt and credit management. Managing debt effectively. Understanding your debt. List all your debts, including credit cards, student loans, car loans, personal loans, and any other outstanding balances. Identify the interest rate on each and prioritize paying off high interest debts first. Number two, use your debt repayment strategies. Okay, one is the snowball method. All right. And what that means is that pay off the smallest debt first, then roll those payments into the next one. So you go from the smallest one, once you finish paying that off, whatever that payment was, and the next payment, you roll that together and you pay that second debt off quickly. The avalanche method is the next one, which is focused on paying off high interest debt first to save on interest in the long run. Remember, a lot of the loans that we have, they compound. So it's very important that you understand your finance charges. It's very important that you understand how they earn interest. And once you understand those things, then you're able to cut the time down. The next one is the debt consolidation. Combine multiple debts into a lower interest loan to simplify payments and reduce total interest paid. Number three, we want to reduce the credit card debt. It's very important that we understand about credit card. We touched bases on this last week, so I want to definitely make sure I say it again. Is when it comes to revolving accounts, we do not want to charge more than 30%. Okay. And number two, when it comes to revolving accounts, we do not want to close those accounts. We want to make sure we maintain that history. So pay more than the minimum payment. Okay, to reduce the interest accumulation. Okay, consider transferring high interest credit cards debts to a 0% APR balance transferred card. So you can actually do research online and find out which institutions are actually offering a 0% APR if you transfer your high balances from your current credit cards to the new credit card. And if you pay attention to this process, you can do it more than once throughout the year. So that means you can actually get a 0% free loan on a credit card to transfer this balance over. Now, keep in mind, do not close these credit cards. Leave 10 to $15 on that credit card as you move that money. You're taking advantage of the opportunities that are there to improve your credit and build your credit buying power. So avoid unnecessary purchases and impulse spending. We know we like to shop. To keep your debt manageable, that is very important. You have to be able to say no. I can't buy this time. I want to get that purse, or I want to get those dress shoes, or I want to get that new suit. You have to say, listen, I can't do it right now. I have a goal. I have a goal that I'm trying to accomplish. Number four, lower interest rates and negotiate terms. So many people think that everything is in stone. No, as I said before, when you walk through the door or when you make that phone call, you have to have a level of confidence to show that you are intelligent, that you understand the financial landscape. And once you establish that, you 50% of the way to the goal. So once you tell that loan officer or you tell that bank teller or whoever is representing that institution that you understand finance and that, hey, what I want to discuss is improving my terms and conditions. How can I lower my interest rate? This is what I want to discuss with you. And by the way, let me give you something to encourage you to give me a better rate. Look at my payment schedule. I've been making my payments on time. I haven't missed any payments. I want to be a long-term customer, but I know that my credit buying power is increasing, right? So I will move. I will move my business to someone else if you do not give me what I deserve. Remember, when you're working hard and you understand finance, it's going to come with perks, but you have to make sure that you have a voice when it comes to your personal financial business. Number five, create a debt free plan. Set a realistic timeline for
Mm.
paying off debts before applying for a mortgage.
Okay.
I've worked with so many individuals that come in here and say, "Well, I think I'm ready to buy a house," and then they finally get around to saying, "Well, last month I bought a brand new car,"
Mm.
and I have to stop and I have to say, "Listen, you know, there's a difference between good credit and bad credit. We all need some form of transportation to get to and from work. We understand this. But the majority of the time, those individuals that go out and buy new cars, that is their second or third car. Okay, they got cars sitting in the driveway at home, and they go buy a brand new car, and then they come into my office and say, "Hey, I'm ready to buy my forever home." No, you're not. You're
Mhm.
not ready.
Mhm.
You're not ready because you did not look at the 50-30-20 rule. You did not look at the DTI. See, this is what we want to do is that we want to be educated and we want to have a consciousness, a level of awareness. So when it comes to our finances, that we make the decisions up front. So when you come in here, we can actually talk a level conversation. We can be here together, not having this up and down motion which we consider that crash and burn. Just
Yeah.
like an airplane with wings. If one wing is heavier than the other, then the other side is going to tilt in the
Mhm.
wrong direction. And guess what happens? The plane crashes. So
Mm.
we want to create equilibrium across the board. Okay.
Okay.
Now, let's allocate extra income from that side job, the bonuses that we make, or the tax refund that we're receiving. We're in tax season
Right.
right now.
Right.
So as you're preparing your taxes and you're going to be looking at that refund, what are you going to do to pay off some of that debt?
Okay.
No, don't just go down to the mall and blow that
Mhm.
money. Let's strategically plan for not only yourself but your family. Remember, we're creating an emotion to go towards a generational path landscape that's going to create wealth. And once you start to create wealth, then it starts to recurring for you and your family and it starts to build up. And this is what we want to do. What are those investments going to look like besides actually purchasing a house? Now, that house will be, besides you sending your children to school, the most important investment that you're going to make. But what it also does for you, it is the strong foundation that is actually needed for us to invest more into our retirement, into our portfolios that we discussed earlier, so that we can really have fun and live a very good life later on. Now, let's talk about breaking that credit down. How to improve your credit score. Pay bills on time. See, this represents 35% of that credit score.
Mhm.
When you're paying your bills on time, so just think about it, out of 100%, 35% comes from you paying your bills on time. Set up automatic payments, okay, for your credit cards, your loans, and your utility bills.
Mhm.
You said earlier that you was busy, unforeseen. Things happen, and then what takes place because we get overwhelmed. Sometimes we forget. We forget. Well, if you set things up on auto pay, then that will help you accomplish the goal. Even one missed payment can drop your credit score significantly. Okay. And that depends on the individual. See, if you have limited credit and then you miss that payment, right? See, that limited credit, you're going to be impacted much more than that 35%. So keep in mind that we want to make those payments on time. Number two, we want to reduce the credit utilization. We talked about this a little bit last week, and I wanted to go into that a little bit more. That represents 30% of your credit score, right? Keep your credit card balances below, again, 30%. The example that we talked about was $1,000. If you have $1,000 high limit, you do not want to charge more than $300 on that credit card. I'll give you another example. If your credit limit is $10,000, keep your balance under $3,000. Pay off balances multiple times a month if necessary to keep utilization very low. Knowing how that creditor reports when it comes to your credit is very important as well. Number three, let's increase the credit limits, okay, without increasing the debt. So the credit utilization that we're talking about, right? We talked about that 30%. Well, what if we took the $10,000 credit limit to $15,000? Okay, a $3,000 balance improves your credit utilization ratio. This is what we want to do. And you can do that. So if you find yourself being in a situation where I had to charge something for my child. My child is off in college and I had to run my credit card up. Well, if you've been making those payments on time, it is very important that you take the time, the opportunity to call your credit card company and say, listen, hey, I have made my payments on time. I need to increase my high credit limit. And once they do that, then that payment or that balance that you have, if it's below that 30%, your credit score will increase. Okay. Keep old accounts open. We talked about this. And it's very important to understand that this represents 15% of your credit score. So keeping that history intact, which means, okay, if it's not a loan, then it's a credit card or some form of account that is revolving. We want to make sure we keep that long history. With loans, we know that they do have an expiration date, so it's nothing you can do about that. But when you have revolving accounts, which are definitely impacting individuals based on that credit utilization, it's very important to understand. I need to keep that history. So the length of your credit history matures, so avoid closing old accounts. Even if you don't use an old card, keep it open with a small recurring charge such as a subscription. We talked about that, that $15 amount that you want to keep on there every single month. Remember, credit is like a muscle. If you're not exercising the muscle, then it's going to gain fat and then it's going to slow down. The value of it is going to decrease. So we want our credit worthiness, our credit scores, and our credit stability to increase. And this is one way to do that. Number six, limit hard credit inquiries. Know what it is you're trying to accomplish for the year. Set a goal, set a plan. Hard inquiries occur when you apply for new credit cards or loans, okay? Too many inquiries in a short time can lower your scores. So we want to be mindful of this, okay? Space out your applications and apply only for necessary credit, okay? A lot of times we'll find ourselves wanting something and that credit just will say to you, well, we have this lender, that lender over here, and some of those individuals will pull your credit 5 and 6 times. You have to say no to that, okay? You have to say, no, this is not for me. Thank you for your time, but I'm going to search for what is good for me and my family. Credit builder loans offered by banks and credit unions to help build your credit. This is another way to increase your credit score. Secure credit cards, okay, require a deposit but helps establish credit history. One key thing here is you want to make sure that the secured credit card is reporting to all three credit bureaus. Okay. The next item that can help you is rent reporting services. Services like Experian Boost can add rent and utility payments to your credit to increase your credit scores. But you have to be mindful of this. If you paid $350, they're going to report it as your balance, and then they're going to show a payment of $350. So when it comes to your DTI, make sure do not include $350 to count against you as a payment. Remember, one of the rules I told you about last week, anything that have less than 10 payments will not count towards your DTI. So remember to remove that payment when it comes to calculating what your DTI is. Now, I did send over some helpful tools and apps for debt management and credit tracking. I hope Sister Tommy, you was able to upload
Okay.
those, and if not, let me know and we'll get them to everyone
Okay.
this evening on that. The final thoughts on this would be managing debt and improving your credit score are essential steps towards home ownership. A strong credit score not only helps you qualify for a mortgage, but also ensures you get the best possible interest rate available to you. By effectively managing your debt and maintaining a good financial standing, you set yourself up for long-term financial success. Start now and prepare yourself for the journey of home ownership. Remember, buying that forever home will be one of the most important things you do for yourself and your family.
Okay. All right, then, Mr. Booth, that like I said, that it's a lot of information, but it's a lot of great information about managing, our credit, and some stuff I have been taking note of, and I was telling my sister I got to apply some of this to my own
Absolutely.
finances. So,
Absolutely.
can I ask you a question? And it's kind of maybe off of
Yeah,
what you're talking about a
that's okay.
little bit. Um, and maybe this is not your expertise, just tell me so. Um, we have right now, of course, all of us have our 401ks and our retirement accounts and stuff, and they're taking a major hit in the stock market because of what's going on right now. Is there anything that we can do or should be doing, or should we just chill out? What should we be doing right now as far as those things are concerned?
Well, one of the things we have to understand is that some of the 401ks are not self-directed, and which means that the employer is controlling the ball.
Right,
You know, the
right.
employer got certain things going on with these brokerages, and it's not a lot that you can actually do.
Mm-hmm.
However, those individuals that do have control, where they can actually participate with what happens for what is being invested on their behalf, they can sit down with their broker and say, hey, listen, let's go ahead and do our review now. And I advise everyone, even with those that don't have control of their 401k, it's very important to really understand what the company is actually investing in. We know that with the stock market, they're going to come what we call corrections.
Mm-hmm.
Even with the real estate market right now, um, even though we're going through a correctional phase, and it's always tied to, and this is something for everyone to understand, when we go through corrections, this is tied to debt. And when we have bad debt in the country, then
Mm-hmm.
some things got to take place to correct that. Okay, so even in the real estate business, and let me kind of just lean on that a little bit, because that's where my retirement's at. My retirement, even though I have a 401k, but my bang for the buck is in all of the real estate that I own.
Mm-hmm.
And as the years have passed by, I have experienced three recessions, right?
Okay.
But I held my properties. I did not sell my properties. So I went through the process of seeing what the country was actually going through, and that the banks were actually causing the correction to take place because they had bad debt on the books. You
Mm-hmm.
had properties that the banks was holding, and that by federal law they got to get them off the books. So what would happen is that they would sell those properties for cheaper amounts. Now keep in mind, I own real estate here.
Right.
Okay, so now the banks are forced to sell properties here. So that decreases my property for that correction period. Now, what we have to keep in mind is that, okay, is the market strong? Do we believe in the strategies? Do we believe in the country? Do we believe in how we live? And the answer is yes. So after the correction took place, this is what happened. Now the property value starts to go back up, not only to where it was, but it
Higher.
passes.
Mm-hmm.
Okay. So, and this is when we say this is our equitable position. My principal balance is here. As an example, if I purchased a home for 100,000, and then say in 10 years it gained 100,000, and then it landed here, so that's 200,000. Then we hit a correction period where it went back down to 100,000. Okay, and it stayed there, say for 2 or 3 years, and then say year number 4, not only it went to the 200,000, but it surpassed the 200,000 and went to 400,000.
Mm-hmm.
So now 100 minus the 100 means I have a $300,000
Right.
equitable position.
Mm-hmm. Mm-hmm.
So that kind of helped everyone with, listen, the market is going to change. We had the administration changed, and some people agree, some people disagree, but we need to know about the math. See, that's what we're doing with the sessions that we're going through. Is fundamentally speaking, how do you understand so you'll know how to prepare yourself? Because preparing is the key, but that doesn't guarantee anything. So we want to take calculated risk. So with your 401k, go into the office, have the discussion, and say, okay, let's look at what the 10-year term, 15-year, 20-year term, what has this entire fund done over the years? What happened during the recession? Go back. And then they'll say, okay, well, we lost 21%, but we gained back 50%. So we're going to lose money. And remember this too with the 401k. If we get into the mode of cashing in, remember, you got to pay 20%
Right.
in taxes. And those individuals that are not of age when it comes to being
Mm-hmm.
retired, you're going to pay an additional 10% penalty. So if that's 100,000, that's 30 grand right there
Mm-hmm.
that you have. And then you got to put that on top of your ordinary income. So that means your tax liability is going to increase more. So I hope that that gives you all a sense. Okay, I need to talk to my tax person, and I need to talk to my brokerage house that invests my money. Now, here's the key: how knowledgeable or the people you're doing business with? How
Mm-hmm.
knowledgeable is your tax professional that's doing your taxes? Or are they engaging with you to talk about what we're discussing tonight? You know, my financial landscape, my generational wealth plan for myself and my family. If they're not having that conversation with you, then that should encourage you to seek further to get what is necessarily needed for you and your family to not survive but thrive.
Okay. 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 All right. Well, thank you for answering that question. Let me see. Did I have any other questions? I don't see any questions. Uh, mhm. No, I didn't see really any questions. Just some comments.
Okay.
Um, a lot of somebody said your college education paid off.
And well, what we
It really
can do,
did. You got your money's worth.
someone did call about the
Mhm.
refinance, um, things. I will talk a little bit about that.
Okay.
We do have individuals that own homes, okay, and they're trying to figure out, okay, I got debt. I got debt. What do I do?
Mhm.
What do I do? And and here's some great advice to consider. Remember, the home that you own, especially if you're looking to sell that home and you have owned that house 3 years out of 5. If you sold that house, you would pay zero taxes for its capital gains because it's your primary residence and you meet the IRS code. Now, for those individuals that are not going to sell their home, okay,
Mhm.
they have kept the house for a period of time, as I explained before, between the 100,000, the 200,000, and 300 and 400,000, to create that equitable position. That means the value of my property minus what I owe. Everyone should call their institutions and ask the question, okay, what do I owe on my property?
Mhm.
And once they take a look at that, the next thing is, what is my home worth?
Mhm.
Now, you don't go pull the tax records, okay? Remember, here in Lee County, we don't have tax records that are representing the true appraised values of the property. What you're looking at Lee County Courthouse is the assessment value, the millage that is actually used for our administration to raise the necessary money to create budgets to run our city, to
Mhm.
run our county. So, how can you do this? Well, you can use tools on Zillow. You can use tools on realtors.com to pull properties that are similar, or you can call that real estate professional like BNB and Associates and say, listen, I want to come in for a free consultation and sit down and allow you to do a CMA, which is called a comparable market analysis. And that will tell you what your home value is. And now you're able to look at what you owe versus the value to come up with the equitable position to make a determination. Should I sell my home? Should I refinance the home to pull the equity out? And remember, either one, if you're selling 3 years out of 5, you pay zero taxes. If you're just refinancing and pull equity out, regardless when it is, you pay zero taxes because you're pulling the equity out, you're getting a loan. Okay.
Okay.
So this is the way to get around paying taxes to Uncle Sam. So yes, tap into your equity if you need it. But remember, this is part of your generational wealth landscape. Okay.
Mhm.
If you need to send your children to school, and you really can't afford to do the student loan, this is another way, is
Mm.
to pull
Okay.
the equity out. Right.
Okay.
Also, if you go to a vacation, if you want to go on a vacation, instead of going down to the credit union or to the bank to get a loan, you can actually extract the equity in your property and stretch it out over the terms that you have in place. If it's 30 years, 20 years, or 15 years, and that will lower that monthly payment. And remember, it's a simple interest loan. So
Mhm.
it's not a compounded loan. So as your property continue to go up in value, which it will do, even if it drops, it's going to come back.
Mhm.
Okay, time has shown this, that real estate is the only asset that continues to go up in value and go through a correction period and bounce back. So
Okay.
I hope that that
Okay.
helps our people in our communities that are sitting on a gold mine. A lot of our families have paid their homes off,
Mhm.
and they haven't done any cosmetic works or anything, not knowing that they're doing themselves a disservice, where it takes just a few $1,000s and some fresh paint, maybe a new roof, some windows, some landscaping, and you can add 50 to $70,000 in value to
Okay.
your property with a small amount of work.
Okay.
So keep that in mind, and I hope that that helps everyone.
It does, and I have a question about that because I had a coworker, and her her husband, and these were very frugal people, but whenever they bought vehicles, they took the equity out of their home and paid for that with that instead of getting a car loan. Is that something that's
Right.
good or bad?
Well, it depends on the position. We always want to look at the budgeting rule, the 50-30-20 rule. We want to look at the DTI as well, because remember, we're dealing with what we call movable property versus immovable property. Movable property is the car.
Mm-hmm.
Immovable property is the home. The home continues to go up in value, right?
Right.
And the movable property goes down in value. So
Mm-hmm.
do I want to commingle those two? So it really depends on the plan. If it's a small amount of money, then yes, great. If I'm spending, say, $25,000 and I got, say, $150,000 in equity, yeah, I would go for that. But if I got somebody saying, well, listen, I got $150,000 in equity, I'm gonna go down here and buy this Mercedes G-Wagon, I'm gonna pull
Mm-hmm.
all my equity out to go buy this car that's gonna lose value when I pull off the
Right.
lot. That is not smart
That's
business.
not smart.
Right.
Okay, all right,
Right.
because these were very frugal people, but she was like, well, her husband says we should do this because you can claim your stuff on your house on your taxes. You can't do a car. So I
Right.
would, I
And
don't
and
know.
I'm glad you brought that point up. I'm glad you brought that point up. Here's another tip. Here's another tip. Remember, Remember, when it comes to the mortgage interest on your primary home, that is reported on the Schedule A when you're talking about your individual taxes. So we got the 1040, all right? The 1040, the federal government gives you a standard deduction if you're single, married, filing joint, married, filing separate, head of household,
Mm-hmm.
okay? You're going to get a standard deduction. Now,
Mm-hmm.
understand that standard deduction is a dollar amount. Let's just say $10,000. Let's just use that as an example. Now, when it comes to your mortgage interest, you're going to deduct the mortgage interest off the Schedule A. Now, before that mortgage interest, let's say that person only paid $8,000, right?
Mm-hmm.
In the mortgage interest, and with the other items on the Schedule A, they got a total of $9,700. Now, remember, the standard deduction the government gave you was $10,000.
10,000. Mm-hmm.
Don't get no credit. You get no
Right.
credit. See
Right.
that? So if you don't understand taxes, again, if you don't have that person sitting over there behind that computer saying to you, listen, let's talk about your financial plan. If they're not saying that first, when you sit down to get your taxes done, in my professional opinion, you're at the wrong place,
Okay.
because they are hindering you. Okay, that's why we're here. We're talking about how do we change the mindset. Well, in that change, that requires you to change some of the services you use as well, because you want to have the plan that is going to be maxed out for yourself and your family. In a day, that if these people can't do that for you, then hey, you don't need to be doing business with them. If they're not telling you, hey, this is how you benefit, let me show you on paper. I got a pen and I got a piece of paper. Let me show you where you're going to get your savings. Let me show you what will help you. If they're not doing that and they're just taking your W-2s from you, your 1098 with your mortgage interest, and they
Mm-hmm.
slapped it in the computer and haven't had a conversation, that's not helping you.
Mm-hmm. Okay. All righty then. Well, thank you for answering that question. Let's see. Don't, okay. So since someone says don't pay for a car more than 3 years. Um, so what do you think length of
Okay.
time should be for paying a car?
Again, it depends on the circumstance. Okay,
Right.
I play this both sides. An individual and then a person that owns a business.
Okay.
Okay, of course, a person that is an individual. remember, we got to deal with the budget. We got to deal with the DTI. We got to deal with what the benefits will be, which there absolutely are none. The only thing that the person as an individual is going to be to write off when it comes to an automobile is going to be the ad valorem tag tax.
Right.
Okay, that's the only thing that they're going to have. So what they're talking about has to really surround the budget. Okay, I need the automobile for transportation to get back and forth to work. Okay, you got to have that. Got to have that. So it is a necessity.
Right.
Okay, it is not a tax deduction for that individual in that circumstance. However, the person that owns a business, they can not only depreciate. Okay, they're going to be able to depreciate that automobile. Okay, they're also going to be able to write off the insurance for that automobile. They're also going to be able to write off the taxes for that automobile. Plus, that automobile may be their means to go back and forth to business, where actually this is a $25,000 vehicle, right? But it earned me by me traveling from here to Atlanta every single day to go do a real estate deal, and I end up earning $100,000. Then hey, that's a different scenario. But over here on the individual side, what matters is your debt. What matters are your essential items versus non-essential items versus savings and retirement. Over here, if I have earned so much money and I need to take that deduction, then that benefits me more here than over here.
Okay. Okay, so it just depends on the individual or in the individual financial circumstances as to how
Absolutely.
long you should finance the car. Okay.
Ab- Absolutely. Remember, it doesn't matter if it's an automobile. The rule about properties is what I said earlier. Movable property versus immovable property. If it moves, which means if it got wheels on it, right?
Mhm.
If it's not stationary, if it's not attached to the land and it moves, it loses value. Okay. So now it becomes about how am I going to pay for it? When can I pay for it? Okay. As an example, if I took a 3-year note
Mhm.
versus a 72-month note, a 3-year note versus say that 6 year, 3 versus 6 years.
Mhm.
Okay, now if I'm doing my budget and I'm already overextended at say 5 years,
Mhm.
why would I do 3?
Right.
To
Right.
increase the payment, now I got payment, what we call payment shock, and then things go wrong. This is why we need to understand the 50-30-20 rule up front. And then DTI, our debt to income ratios. What does that look like? Do I go buy a car and I have a 60% DTI? The answer is no. No,
Mhm.
you got to get an Uber. Yeah, you got to figure out a way to get back and forth another way, because we got to get that DTI down to 43%. But what we're doing as a community, we're basing everything on emotions.
Mm.
We're not doing math. We got to do the math. Once we do the math, then the answer is going to be in the math. You just got to follow the plan. And what is going wrong in our community, man, I want this. I had a customer here and said, well, I want a vet. I said, okay. I said, well, what's the plan? I'm going to get the vet. That was their plan.
Okay.
And I said, no, no, we need to discuss this so you will know yes or no. Can I afford this based on the math? If I can't, then I got homework to do. It's just that simple.
Mhm. Okay. And can I ask you a question? How does insurance, uh, what part does that play in your financial planning?
Oh, it's very, oh man. Listen, our families are underinsured when it comes to not only death benefits,
Mhm.
but life benefits. Hear what I just said.
Mhm.
See, everybody thinks about, okay, I need a death
Mhm.
policy. A death policy when I when I pass away, and I want my family to be able to put me away
Mhm.
nicely.
Mhm.
This is what we talk. We never talk about life benefits. You know, getting that universal policy that is actually going to accumulate a value while we're here,
Mhm.
that would give me the opportunity to buy more real estate, to increase my net worth by doing certain things, and matter of fact, getting tax benefits, tax break. So what we need to be able to do is, again, back to the 50-30-20 rule. That 20%, that savings, that retirement, insurance is in there as well.
Okay.
Okay. Insurance is a form of investment.
Okay.
Okay. If I buy a policy for say Troy
Mhm.
Jr. Troy Jr. is 26 years old right now. I bought a policy for Troy when he was 3 years old that is paid up. When he turned 11 years old, the whole policy was paid up. So
Okay.
he has a $50,000 policy, right? And now it has cash value. So when he's ready to purchase a home, he's
Mhm.
going to pay. He's going to borrow from himself the
Okay.
money that's necessary. Now keep in mind what I'm saying. What are you saying, for? He's going to borrow the majority of the money from the bank, and then he's going to come out of his investment for the balance of the money, for the balance of the purchase price of the home, right? 100%. See that? Instead
Mhm.
of getting a grant program or doing a second mortgage, I was able to set up something for him that he's going to be able to cash in on to
Okay.
use to purchase his first home. Now, here's the key. He will eventually take the equity from that home, put it back
Back
into
into
his
the
insurance
insurance.
policy,
Okay.
and he will continue to earn more money.
Okay.
So that's an idea to think about as well.
Okay. All right. So um how much life insurance do you think a person should have? Does it depend
And it,
on?
mhm. And that's a very important question. But everything going, and I'm driving it home. If you notice, I'm going to say it again. We're going to start with the 50-30-20 rule,
Mhm.
because see, the 50-30-20 rule is going to tell you what you can and cannot do.
Okay.
Your debt
Okay.
income ratios. How much money can you afford? Because
Four.
see, if
Mhm.
you if if you tapped out with essential items, non-essential items, your savings and retirement, then you got to figure out, okay, I need to be able to decrease the non-essential items. I need to take that 30% and I need to start working it down to 15%. And that would give me an additional 15% to slide to my 20. So my 20 becomes 35%. Now I'm able to invest more money from my 35% versus the non-essential item, which has been decreased down to 15%, and I'm making the same amount of money. What I'm doing is I'm understanding the math. And once I understand the math, then I can start shifting. This is what is good, my essential items. So I'm going to move to the non-essential items. How do I decrease my non-essential items so I will have more money to invest in savings and in retirement? That's how you make that decision. And then once you do that and it starts to earn money, remember, that would be counted in as positive income. You're just not cashing in on it, but
Okay.
it is real money,
Okay.
and you are improving your financial landscape. So that's how we want to look at all of that.
Okay. All righty then. Well, I think last week you said you were going to talk a little bit because we're approaching time, but you said you were going to talk a little bit about estate.
Yeah,
Was
the
it
trust.
the
Yeah,
trucks?
and that's
Mm-hmm.
what we moved that to next week, right? But I
Mm-hmm.
okay, because I want to do a full session on a little bit what we got into tonight,
Okay.
about insurance, the
Okay.
trust. Remember what we are trying to establish, people, is protecting our families.
Mm-hmm.
That's the best way for you to really think about trust. And when it comes to wills, understand that even though you may have a will, if something happens to you, that will has to go through the probate process. Wouldn't it be nice if something happens and you don't have to deal with that? You don't
Mm-hmm.
have to go get a
Mm-hmm.
federal identification number and deal with the court system up there at the courthouse where, they got to tell you, hey, now you can move. You
Oh,
got to
and
run
and
notices.
then Troy, what I have learned is with a will, it doesn't necessarily matter what you put in there. It's up to the judge. He can come in and change the stuff that you
That
have in your will.
See, this is our people think that you're in control just because you got a will. No, you're not. You still got to
Mm-hmm.
go through the probate process. Now, when you deal with trust, that eliminates a lot of that. Okay, it's a
Mm-hmm.
lot of power there. Every family needs to have a few things. An attorney is definitely one of them,
Mm-hmm.
and you have to start to reset your mind. We're changing the mindset. Again, I'm going to repeat it 1,000 times. Changing the mindset, setting the budget, understanding the math, and having a plan. And part of that plan is having an attorney.
Okay.
Part of that plan is having a great insurance agent,
Mm-hmm.
okay? And you definitely want to have a real estate professional. A lot of people say, "Oh, I do real estate." No, 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 no. You need a real estate professional that can tell you some ins and outs. How do you maximize your opportunity when it's owning additional properties? How does that look to cash out on those properties in a loan and then invest that money into insurance? Did you get that?
Mm-hmm.
Okay,
Mm-hmm.
you gain equity over here. See, a lot of people think about, okay, I want to pay bills, I want to do this. No, how about invest that equity, invest it over here. So now you can afford to pay that attorney to set up your family trust, to
Okay.
set up your land trust, where you and your wife, and for men understand this, is that you and your wife becomes the directors and your children are the beneficiaries, and then you set up other type of things to run your businesses, and you separate yourself completely from that business activity, so you actually look like you have absolutely nothing and the trust owns everything. And this is another benefit. A lot of families that are not in our communities are taking advantage of the rules that the government have in place. So we just want to start reading the pages in the playbook versus just being a superstar on the field. See, we know how to play the sport, you know, but we have to understand this. Just because you make a touchdown doesn't mean you win the game.
Mm. Mm. Okay. Well, all right then, Mr. Booth. Every time I get on here with you, time flies by. It's already about 8 o'clock. So I thank you for all that information. And I'm going to post the information that you provided us. I will post that in the comments so that the individuals can go back, all the viewers can go back and access that information. Once again, thank you so much.
You're welcome again for having me, and thanks again for your prayers and thoughts.
Yes,
We
yes,
really do
definitely,
appreciate that. Thank you all. Thank you.
definitely thoughts and prayers with you guys, and I'll be seeing you all this week sometime. Um, but anyway, guys, just a reminder, Mr. Bruce is going to be back with us next week, and he's going to talk to us about this trust, and so we'll know how to do our estate planning and everything, because we want to do what is best for our family, best for our children, and realize that what our intentions are is what really happens. Okay, because people have intentions, and then after they're gone, uh, someone else comes along and does something totally different with it. Um, Please like and follow Ardeen Thomas and By Juju for You on Facebook, on TikTok, and on Instagram. Is it Instagram? I think it's Instagram. I don't even know these pages. And Lemonade, I got a Lemonade page. I ain't even been on that, but follow me, y'all. All right. And Saturday, March 22nd, we're having a spring pop-up shop at St. Luke AME Church. We got By Juju for You, Joyce's Jewelry, MD Designs, the Avon Queen, Stephanie Lee, Mary's Art, Why Not Yarnery, Josie, Beautiful VIP. We have Electric Vogue by Crystal. We have V Creations. And so, and then we have Lynn Three will be there as well. So come on out and shop with these wonderful vendors. Support local, buy black. And so come on out and get some handcrafted items. Also, don't forget, Juneteenth will be celebrated at St. Luke on Saturday, June the 28th. This year's theme is From Chains to Change, honoring freedom and embracing inclusion. The event will be held on the campus of the historic St. Luke AME Church from 4 to 7 p.m. We are currently seeking vendors, sponsors, and entertainment. If you're interested in being a vendor, a sponsor, or providing entertainment, please contact me, Julia Ardeen Thomas, Joyce Duchess Thomas Vincent, or Mr. Jerry L. Jackson. And please stay tuned for additional information. Contact Joyce Duchess Thomas Vincent for all of your Mary Kay needs. She is our independent Mary Kay consultant. Don't forget the Divinely Guided podcast. Joyce and Adrielle, mother-daughter team. It's very good, very informative, and those podcasts drop every Monday. So tune in. They do. You can. Joyce will let you know usually on her Facebook page, Duchess Thomas, that they've dropped, but they also have a Facebook page. And so if you subscribe to the Facebook page, you won't miss any of them. Subscribe to Juju's Dollhouse YouTube channel. And you can keep up with everything that's going on with By Juju for You. And you can also catch up with all of these editions if you want to go back and listen to some of this information that Mr. Booth has given us. All of the shows that we have done with Mr. Booth and all of my previous shows are available at my YouTube channel, which is Juju's Dollhouse. All righty. Please don't forget that Juju is a proud sponsor of Hold Up the Light, nonprofit organization. All right. So for now, we're going to say good evening. We're, of course, going to say thank you for joining us. Please like and share this episode of this show, and meet us back here again next week so we can get some more information. Thank you, Mr. Booth, once again for being so patient with us and giving us so much of your time. I do not take that for granted. I know that this information that you're giving, this time that you're giving to us and not charging us anything, is something that people pay a lot of money for. And so I do truly appreciate it. Thank you. Anyway, I am Juju. I am that mountain moving giant slayer. I'm walking by faith, inspiring hope, and showing love all along the way. And until next time, guys, I wish you all much love and many blessings. Good night.